Kev, you know, you could, the people who are more cautious or are still bearish are citing these alleged risks to the market. Not to discount any of them, they may be real risks. How significant each one is the real question. Too concentrated. We just went through, you know, the Tony's list and some of the facts around that. They say the market's too reliant on rate cuts. You know, we're not looking at March anymore. All the Fed speakers of the week, and there were many, are on message that we're going to get rate cuts likely this year, but it's not going to come in March. So we asked the Wharton professor, Jeremy Siegel, from your neck of the woods, around Philly, is the market too reliant on rate cuts? And he's said no. Listen.
At this particular point, I don't see the need for the Fed to lower. I mean, take a look at all the real indicators. They haven't slowed down. Even the advanced indicators have not slowed down. When they begin to slow down, that and if inflation's under control, which I do think it is, we're going to have those lowering of rates. But I'm not saying that this bull market at all depends on the rates being lowered in March or really even in May.
Is that factual, Kevin Simpson? Do you agree with the professor?
100%. It has to be, because in December, Scott, we came into the year with 100% of us saying there's going to be a rate cut in the first quarter. There's going to be 7, 8 rate cuts this year. And if we don't see it, the market's going to fall off the cliff. Well, the Fed chair put the March rate cut in the rearview mirror. And now May is potentially a coin flip. But we don't need rate cuts at that aggressive level when we have an economy that's still strong. We have a labor market that's incredibly robust. And it comes down to earnings season. These aren't like last year where they're better than feared. These earnings are good. And if they're not good, the stocks are getting punished. So I think we need to see rate cuts this year. I think we will see rate cuts this year. But I don't think we're reliant or dependent upon seeing them immediately and seeing them at mass. In fact, I think the longer we can hold out, the better, and the more we can stretch it out, the better. It's a precarious position, knowing when to cut and when not to. You don't want to keep them too high for too long. But so far, so good, and I think the Fed deserves a lot of credit.
They may. Bryn, I could almost make a counter argument that don't we need rate cuts to at least confirm to us that the Fed believes that inflation is going where it needs it to go, and that, you know, yes, they can use the strong economy as an excuse or an insurance policy to wait a little bit longer. At some point, we need them to cut to tell us, yep, we agree. We agree where the market is placing its bet. Inflation's going down to 2% target, and therefore, we're confident enough to cut rates.
100%. I mean, I respectfully totally disagree with Professor Siegel, is that there's still 5 rate cuts priced in, right? So March is potentially not on the calendar. If we end up pushing those out, and actually we're not going to get rate cuts, which wouldn't really make sense to me unless inflation really started heating back up, it just makes sense to have rate cuts. But if the market had to digest that we weren't going to have rate cuts, we would absolutely, within specific sectors, re-rate lower. I think that's where small caps would continue to be under pressure. These economically sensitive areas, the regional banks, I mean, to me, are like, everyone thinks the New York bank is isolated. There's 500 billion of commercial mortgage-backed loans coming due this year and next year. And so I think that not having a rate cut would definitely be a huge dampener on really specific sectors within the market. Maybe not Nvidia or AI adjacent, but I think the overall market would have an issue with the multiple it was today.
Well, that's the thing about the valuation, which, by the way, Jimmy, you know, Professor Siegel didn't even think that the multiple on the market was, quote unquote, too rich, which is yet another one of these risks that you hear from people who say this can't possibly last and maybe shouldn't even be where it is now. He says even at 20 times, even at a 20 PE, yeah, it's a little bit higher than the historical average, but still projects to me a good 7 to 8% rate of return over the next 3 to 5 years. Still much better than the bond market in my calculation. Goes to, you know, where the part of the conversation has been over the last 18 months or so, whether, you know, bonds were a better play than stocks, and now whether that pendulum has swung back to equities, or, you know, even in fact both can go up quite nicely together.
Well, along with the professor, I do dismiss that as a risk, the valuation, and let's call it 20 times, which...
Why do you dismiss it as a risk? I mean, S&P is 20.5 times 17.
Hang on, Tex. I'm about to tell you.
Yeah.
If you take a look at the equal weight S&P 500, RSP is the ticker. The multiple on this year's earnings is 16.4. So we can continue this debate that we're having already about the Mag 7, but when you take out the Mag 7, the average stock is trading at 16.4 times. That's not expensive. And I'll also make the argument. That is
the professor's argument, too.
Yeah. I'll also make the argument, 20 times? It ain't cheap. I get that. But this is not, it's not absurd. And it's not absurd for the, when we're talking about the Mag 7, remember the earnings growth that you're seeing there. It's pretty tremendous.
But yet, you say it's not absurd, but yet you come to me at the very top and you say, well, I'm not thinking about buying anything. I'm thinking about where can I trim what I've got that's up a lot, and Nvidia's at the top of your list. You don't think that now the so-called Dean evaluation? No, I'm gonna think about how I want to say this. The so-called Dean evaluation at NYU Stern, Damodaran, he owns Nvidia. He's owned it a lot lower than here.
Yeah.
And clearly he's uncomfortable with where the valuation is because he used the word the other day, insane. With me.
Okay, insane to me was Cisco.
This is a guy who makes his living literally looking at valuations of stocks. He's
mad respect
famous for it.
Mad respect for him, but this is not Cisco at 100 times earnings 25 years ago. This isn't Qualcomm at 200 times earnings. With regards to my comment on the market overall, it's more the short-term move. It's not the multiple, all right? 35 times forward earnings on Nvidia for the growth rate. The growth rate's like over, what, Jason, over like 50%?
I think he would agree. I think you make a really good point. I'm going to let you continue. I think you make a really good point. And maybe his queasiness, if you will, is more due to the price appreciation than the multiple. That's fair.
Yes, and that's where my
why I think better said that way.
That's where my queasiness is as well. 600 billion. I keep coming back to this number. 600 billion of market cap added to Nvidia over the last 5 weeks, and it's a fabulous company. But I'm just telling you, nothing fundamentally has changed in the company, even close to 600 billion. So it is sentiment, it is exuberance, and it can continue. Just to be clear, I'm not selling today, but I am waiting for a rollover day, and then I'm going to take some money out of tech.